So welcome community members to another Friday update, a slightly different one today. We've given Nick Noonan and Betty a rest, and we've brought in a special guest to join us today. That's Andrew Firth from the Rushmore group. Andrew's got vast experience in forensic accounting, business valuations and expert witness reports. And he'll be giving us a rundown today on some valuation methodologies. And then the panel will have a discussion with Andrew around how we can use these for discussions with bankers, purchasers, family members in terms of succession planning, and maybe also looking at how we get the structure of the businesses right coming out of COVID-19. But before we do that, we'll hand over to our trusted tax consultant partner, Peter Bembrick, who will give us his weekly update on JobKeeper and anything else that you need to know about. Without further ado, Peter, over to you.
Okay, thanks. Thanks, Tony. Welcome everybody. We've got a smaller group today, but hopefully we'll get a few more coming in. So the slides are pretty similar to what I think most of you were probably on the last couple of calls that we've had. So that obviously you're all still dealing with JobKeeper, and it is starting to settle down. So there won't be quite as much to talk about here, fortunately. So there's all the basics there. The service entities we've touched on certainly last week, and I think that's probably the biggest area still of development. So we'll talk a little bit about what's happened over last weekend, really. So since we spoke last Friday, we might have any. You're obviously dealing this week has, I guess, been sort of crunch time in terms of some of the practicalities of registration and making top-up payments and to employees. So there's would have been a bit of practicality to deal with. Since we've got till 31 May, I guess you've still got some clients who are where you can still register them, and but you probably dealt with a lot of these issues for your clients already, I would expect. And then we're going to be moving forward. So we can probably just move through to the next slide. Okay, and we've talked about a lot of this before, the basic test periods. Again, obviously March or April 2020 is the first months you'll be looking at, or the June quarter. Actually, one development which probably we may not be reflected on the slide is the ATO guidance. I think that actually there might be something a bit further down on this, but the ATO guidance about calculating turnover is so that we how you I guess get into the apply the basic test to the particular period. So that's something that probably certainly has come up this, and I'll get to that. But you know, you're looking at March and April periods or the June quarter, and that's when we talk about projections. So again, we've talked about that in the last couple of weeks, and that's probably one of the key things you'll be looking at going forward for clients. Otherwise, if you've got those clients that are missing out for the first couple of periods, but you might be still seeing some delayed COVID impacts on the businesses. So that's where you'll be still looking, since the whole JobKeeper thing goes for 6 months, you may still find there's opportunities to bring clients into the system who didn't otherwise get in at the beginning. And of course, once they're in. So it's something we're going to all keep in mind, that if we see an opportunity to get a client into JobKeeper and start receiving the payments, then we should do that. But otherwise, that's there. So I suppose I might just a couple of comments about the projected turnover, the turnover at the very bottom of that slide there. Of course, just remembering that turnover is taxable supplies and GST-free supplies. So I had a question from another accountant, actually who's not on the line here, but earlier about a client of his who is receiving, that they do currency trading. So they've got about 8 employees and do predominantly currency trading. So there's a little bit of commissions there, but the vast majority of the revenue of the client is input tax supplies. So that's not part of GST turnover. He doesn't put turnover on the BAS. So I was asking around in the office, but I don't believe we that would fall within turnover. So unfortunately, I mean, most of our clients with financial suppliers perhaps probably don't have employees. We look after fund managers, and it's the funds don't have the employees, but the fund managers do, and the fund managers are receiving management fees and performance fees, if there are any performance fees this year, and so they would be impacted, and to the extent that we're talking about taxable suppliers there, so that the actual fund managers would qualify, but not the funds. But the funds probably don't have employees. So I don't know whether anyone else has seen those sorts of situations, but we're probably in that particular example, I don't think his business client is going to benefit. They're connected with Australia, and that links in. And Paul Bailey, who's on the line, we chatted earlier about another non-COVID related matter, and we were just also chatting about a JobKeeper. Paul's reminded me about his example, in which was pretty clear that remembering sole traders, and I think Paul's client is a personal trainer who happens to be stuck in the US, and so will not be obviously is able to do a little bit of work remotely, but not a lot. So that was probably a good reminder that sole traders, so people without employees, will certainly be people we can be looking at, and there'll be something we should be trying to register. But in that case, there's a couple of in Paul's example, there's a couple of things happening there. One, if by any stretch of the imagination she was able to get any revenue in the US, well, that would not be connected with Australia, so that's not part of taxable supply, part of GST turnover. But anything that she's doing remotely with Australian customers would be. So there's probably some turnover there, but Paul's explained that there's actually obviously very little. So there's a huge drop off in turnover. So in that case, definitely should be qualifying for the applying for JobKeeper. And actually, Paul, something we didn't touch on, which might be worth noting, if anybody has, get a reminder that in the if you're in anything like that, personal trainer or gyms, restaurants, cafes, there is that $10,000 grant for the New South Wales state government. So anybody who's impacted by the distancing restrictions, might be able to look at that as well. So perhaps Paul, your client might have a look and see whether that applies to your client. Now we might just move on to the next slide. Again there. Okay, so this is all alternative tests, and we talked through all that last week. For most of you, I think again we're probably on the call. Various scenarios, and I won't necessarily go through it in too much detail again. But the ones that people have been looking at, the substantial increase in turnover is where you need to do some calculations to see what qualifies, and irregular turnover is something that's a little less clear, and you really need to think through, well, where does an organisation have lumpy turnover that's irregular, not cyclical, but just irregular during the year, that where an averaging approach is more rather than a point in time comparison is more appropriate. So again, that's all about finding an appropriate test period to do the comparison. So I won't dwell on that too much unless clients have. I'll just look at Mark's question maybe to see whether that's relevant here. So Mark's question is: the client is in the logistic business, pays and recovers substantial GST freight and duty payments for clients. Freight rates have gone through the roof, so outlays and billings are holding up, but the company's part, which is recognised in management accounts as income, is obviously more than 30% down. So I take it you're referring to, so the turnover. I suppose the key question there, Mark, is that if your client might not consider the full amount that they bill to be turnover, but if it's recognised that way in the BAS, so if they effectively, so I guess there's businesses that would have very high turnover but low margins. So, and unless you can suggest that they're effectively doing a cost recovery, so something's more like they're acting as agent, and so something that might be recovered, so that it's not really their income, it's just a cost recovery, then perhaps if you don't consider that to be turnover because they're acting as an agent, then you might be able to exclude that from the calculation. But overall, if that's not how it's accounted for, and if the billing, as you say in your question mark, if billing holds up because those amounts, those outlays and then recoveries are still holding up, but what your client ends up getting is actually significantly down, as in their profit, certainly their profit is down and their margins are down, I'm not sure that would necessarily help. So probably not good news there, but that is, I think that is a significant problem. And so it really does come down to how you consider that to be and how it's accounted for, I think. Hopefully that answers your question, Mark. All right, so maybe just move on to the next slide. Okay, so this is something I just wanted to just dwell on slightly. So we touched last week on service entities, and what we knew last Friday was that service entities were recognised as an issue, and there had been Treasury announcements to solve that. Certainly there was mention about groups and consolidated and GST groups. So what we've seen since what we sort of got over the weekend were, firstly, the actual Treasury amendments to the rules, and you'll find that if you go through the Treasury website, there's a link at the bottom to the rules under JobKeeper, and it's the legislative instrument that for the rules, and there are we call it amendments, pending amendments, I think something along those lines that set out what are the actual amendments to the rules that will be put through to address this. And in that it's clear from that the amendments the Treasury are putting through are to consolidated groups, consolidatable groups. So if you're in that wholly owned corporate groups, but not have chosen not to consolidate, that's still treated the same. And a GST group, which of course has a 90% threshold, not 100% ownership threshold, and is a broader, generally the concept of GST group is broader than consolidated group. So, and that can get quite complex. I've sat in on a Tax Institute webinar yesterday that went through some of this in a bit of detail, and so there can be all sorts of scenarios, and it's a matter of just working through if your client has a tax consolidated group, you'll know that, and if they have a GST group, but what is the group? And one of the points that was made there was that if you could have different, there could be the particular service entity might be a member of different groups, and just so it could get complicated, or the structure may be quite simple. And obviously we've seen a couple of examples where it's fairly simple, but it's a question of just does it qualify. The big thing that's missing, and so the point there is if you fall within the Treasury amendments, so if a service entity exists simply it employs staff, and it's predominantly the purpose of the service entity is to supply labour to a trading entity within the group, then the common sense approach is to look at the turnover of the trading entity, or if there are more than one trading entities, aggregate the turnover of all the relevant trading entities, and then from external, basically effectively from external customers, and then that's how you do the calculation. So not basically on the service fee, which is simply internal. So that would work for a lot of scenarios, and I've got a major client where that will help us significantly with some of the companies that are within the tax consolidated group. There was probably a slight, I guess a slight caveat to that, which I've heard a couple of people make mention of, is that the entity, the employer, remembering this is all done on an employer by employer basis, the employer should actually be carrying on a business. So a couple of people questioned if you're putting through service fees at markups, that's great, that works. So I've seen situations where a business, you just have a service entity within a group, it all washes out through the accounts. They don't even bother applying a markup. So effectively the wages costs are just recharged with a no markup. So the question, that there's a technical issue there as to would you consider that service entity to be carrying on a business if it's not actually trying to make a profit and never has and never will make a profit? So maybe hopefully the ATO wouldn't take a too hard a line on that, but it's certainly a query that's been raised, and just probably something you might want to be a bit careful of. But outside of that, and I'll try and move through because I haven't got too much more to cover, and then we can move on to the panel. Outside of that, the biggest concern will be that the Treasury amendments don't deal with service trusts that are under perhaps common control, and that might be professional services, an accounting firm, a law firm, other clients, either yourselves or clients that you might have, where you have a service trust. Usually it's a unit trust, but it could be discretionary trust, carries on employee staff, provides those services to trading entity that might be carrying on the professional practice or the other business. It's not tax consolidated or GST groupable, but it's the partners, the owners of the business are the same people, or through their related entities, who control the trust. So in that scenario, the Treasury amendments don't really help you. But what the ATO has released, that was the other big development, Practical Compliance Guide 2024, is a document which some of you may be aware of, may have seen, which goes through a number of schemes that the ATO considers they'll look at for people to take advantage of JobKeeper. For example, the first couple of examples are the obvious ones, that if you simply manipulate your turnover, hold back revenue, bring forward revenue to different periods to get the 30% decline, they'll say that's something you've manipulated. That's clearly a scheme that they'll take a close interest in, and potentially disqualify the entities from JobKeeper. When they get to example 4, they say, but okay, if you've got a service entity and there's obviously an agreement between the service trust, for example, and the trading company to supply the staff to the trading company, and if that in that situation, they actually give a fairly extreme example where it gets reduced by the trading entity has an 80% reduction in revenue. And so they say, well, if you keep the same staff on and JobKeeper doesn't apply, then there's going to be the service fee is going to be pretty much the same. And so that's going to have a significant impact on the trading business, but you're not going to get have any ability for JobKeeper, because you have to compare the service fees between periods, unless has been a significant reduction. Which would generally involve employing a lot less people. So the probably a common sense sort of commercial approach to that is to say, well, which is what the ATO discusses in their example, is that if the trading company and the service trust get together and agree on a reduction in the service fee, on the basis that obviously the trading company is suffering, the service trust should share some of that pain, and so then they'll negotiate a reduction commensurate with the reduction in the trading company's income. Then the ATO looks at that and says, well, it's driven by external market for the external impact of the market, so we see that as a low risk. And examples 5 and 6 are sort of variations on the same sort of facts. So that gives us a fair bit of comfort that in those situations the ATO will accept what's being done, and then it's a matter of there's some practicalities around putting that into effect, whether it has to be done legally, whether it can be done within the agreement, making sure that it be done. It may not have to be done in writing, but certainly give effect to it, account for it. One client that I was talking to was saying, well, they've looked at their business for March and done the March comparison, but they've already done their March accounts. But perhaps look at they're obviously doing April management accounts at the moment. Perhaps look at amending the service fee for April based on the impact that the actual trading company suffered for March, and remembering that each employer can do their own will do their own JobKeeper registration. So really there's no reason. So there's no reason why. Apologies for the background noise there. There's no reason why the trading company can't register do a calculation based on March turnover, and the service trust do it based on April turnover. So that's probably the main thing. I would just say there. And so there's a point there about registered charities. There was an amendment there. There's a few other things announced, but they're probably main things. So just maybe move on to the next slide, and I'll there. Okay, and I wasn't going to dwell too much on this slide. Probably the only point to note there is under assistance with calculating decline in turnover, that's LCR 2021. You would probably read a lot of discussion around what is turnover, cash versus accruals, how do you actually calculate turnover, and so that there's been confusing messages coming out of the ATO, and this probably brings it to a head a little bit and says that technically the way the rules would work, GST turnover is based on the supplies that you make in a period. So that should really, regardless of whether it's cash or accruals, when you bill the clients, if you've done the work, provided the services, provided the goods, whatever, then that's when the turnover should be considered, should be attributed to that period. But what the ATO is saying is, well, we realise that's not always going to be practical, and so we'll accept different approaches, whether it's cash, accruals. They certainly want consistency. That's one thing that's absolutely clear. So if you're using different methods for different periods, that's going to be questioned. If it's got to make sense, and if a good starting point would really come back to what the approach that's taken in the BASs. So if you do that, you're generally probably going to be in most cases fairly safe, but they're not going so far as to saying you have to use the approach, use a methodology that's taken in the BASs. So and that's certainly going to feed into calculating the projections, and of course projections are then where it gets a bit problematic too, because so the key thing there is how reasonable are the projections. So again, the discussion will be, the issue thing will be, you've got to do as much homework, document the projections as well as you can, and then if the ATO's again made it clear that if they're a little bit out, they'll be relatively understanding, but if it becomes clear subsequently that the projections were way out, they're going to question the basis on which they were done in the first place, and that may well be, again, hindsight might well cause the ATO to question whether the fact that the business should have been eligible for JobKeeper. So, and there's a bit of a summary of some of the actions, which again you're probably all fairly well aware of. Happy to take any questions on those, but otherwise we can probably just about move on to the next part of it. Tony, you're muted.
Thank you. And thank you for the update, Peter. As I mentioned at the start, we have a special guest today in Andrew Firth from the Rushmore Group, who happens to be another valued member of the HLB community. Andrew will give us a presentation on various valuation methodologies. As I said, he's got vast experience in forensic accounting, business valuations, and expert witness reports. So Andrew will do a presentation, and then we'll have a panel discussion. And the panel will include Todd Gammel, who's our regular panelist. And today we brought in Nicholas Guest, who is a partner in our corporate advisory team. So Nick and Todd and Andrew will have a discussion following Andrew's presentation. Thank you for joining us, Andrew, and over to you.
Thanks, Tony. That's great. Okay, I just thought I'd set the context around valuation by just running through very quickly the three main approaches. You're probably all familiar with them, but I thought it just doesn't hurt to run through them very briefly. So the first methodology that I probably use about 90% of the time is the capitalization of earnings method. That's like your typical multiple times by future maintainable earnings gives you the value of the business. It's really suitable for where a business is generating consistent earnings and consistent cash flows, and it's a mature business. And as we'll see with the COVID-19 impacts, often that assumption breaks down, because obviously for the next maybe certain foreseeable future, those earnings won't be the same as they've been before. So clearly there may be some sort of mechanical or logistical problems in applying that perfectly in this environment. The second methodology is the net present value methodology, or discounted cash flow, and I'll go through that. I don't personally use it very often, especially in the sort of small to medium end of the sector, but it does have its application, and all the other valuation methodologies are really a proxy for that methodology. So it's one of the most sort of academically sound approaches to take. And the third methodology is the net assets methodology, which is basically the net assets on the balance sheet of the entity with some adjustments. So if I could just go to the next slide, please. So starting with the first methodology, capitalization of earnings, I've just put a hypothetical example there. Business makes $100,000 a year, has an EBIT multiple of 3.5. It's the fair market value of the business in that simplistic sense is around $350,000. This methodology, as I said before, it assumes that 100,000 is going to be generated in perpetuity for literally forever. If we go to the next slide, please. So what I've done here is, you can see in this next slide, I've represented that the same hypothetical example, $100,000 a year. You can see in the first line of that, across that table, you can see the 100,000 with the green circle around it going out into perpetuity. You can see I've taken off the tax, I've got the after-tax cash flow, discounted that, and of course you come back to $350,000, which is, it's just representing that constant cash flow in perpetuity. If I could go to the next slide, please. So in a COVID-19 scenario, clearly we're seeing businesses have their earnings have dropped off a cliff. They're forecasting either negative cash flows in the future or substantially reduced cash flows. And what I've done here is I've just instead of 100,000 each year, I've just, in this hypothetical example, put 25,000 in year one, and then gradually increasing after 4 years later, it returns to its previous trading results. So you can see with this example, the business that on the previous slide was worth 350 is now worth roughly $270,000, with all the other assumptions holding true. And clearly, if some of those cash flows were negative, it would reduce even further. So we're seeing, so out in the marketplace, I'm seeing people are sending me forecasts and budgets with negative or very small profits, and I'm translating those into reduced value, and a lot of them are in the process of therefore restructuring their business. But if I go into the third methodology, just to round out the overview, you can see on this slide, we've got, again, just a hypothetical business. You can see all the various operating net business assets, cash, debtors, stock, plant and equipment, accounts payable, wages, and employee entitlements. You can see in this example that the sum of those assets less those net business asset liabilities is $585,000, which was, in our hypothetical example, higher than the 350,000 or the 270,000 we calculated earlier. So you can see that in this hypothetical example, this business doesn't have any goodwill. So even if it had greatly reduced or negative cash flows in the future, in my opinion, the value wouldn't decrease. The goodwill, there's no goodwill there anyway, so it wouldn't go down. But if we go to the next slide, please. So this slide, I've basically taken the same spreadsheet. I made a few adjustments. I've assumed that the inventory was overstated, and I've put through a negative adjustment there. You can see I've brought the value of the net business assets down. When I've done that, I put in some employee entitlements. When I've done that, you can see that the net business assets dropped to 345,000, and in our pre-COVID-19 hypothetical value of the business of 350,000, in theory, we've got $5,000 of goodwill in this example. If I go to the next slide, please. That's great. And you can see that if in a post-COVID world where with reduced cash flows, our capitalized value of the business dropped to about 270,000, it's still less than these net business assets. So in this hypothetical example, the goodwill would just go to zero, and the rest of the value would remain the same. So that's a very high level overview of valuation. You can sort of see the dynamics of how those decreasing cash flows impact on goodwill, and depending on the business, it'll reduce, but it also depends on those net tangible business assets. And that's all I had to say for the moment. If there are any other questions or comments?
I think from me that the uncertainty, and because this is unprecedented. It's not like what happened when we had the GFC, which was an equity and sort of funding issue. This is a demand-driven issue. So, and each industry is going to be different. So you're going to have fun creating or getting your feel around how that is. And I suppose that means that we're going to have to wait 3 to 4 months before we start to see how that rolls out into any sort of trend. Is that right?
Yep, certainly from my perspective, the data's just not, I mean, in business valuations, particularly in Australia and in the small to medium end of the market, the data's pretty poor anyway, even prior to COVID-19. So from my side of things, it's still too early to see from a data point of view, but from all accounts, talking to business owners, it's pretty drastic.
Paul's whipped in a very relevant question for everybody who, most of the people on this webinar. The most popular method for valuing accounting firms, Andrew?
Sub 1 million turnover, it's still obviously the capitalization of revenue, so a sort of cents in the dollar approach. Once you're getting above $1 million in turnover, it's more of a capitalization of earnings approach.
And the complication in there is obviously that a lot of accountants have very personal relationships with a lot of their clients. So it's hard to, there's a lot of different ways you can transact through that and keep all of those. And I suspect you've had a few disputes over the years between accountants because there's always different views of value.
Yes. Yeah, it's interesting. I've in the last 6 months, I've valued maybe 5 or 6 different accounting firms, and the multiples have ranged from like $1 up to $1.40. So this is per dollar of revenue. So there is variability there. You're right. There are different levels of, I suppose, what you'd call personal goodwill. But I also think that a lot of that's still captured in that multiple anyway.
Yeah.
So it's hard sometimes to separate out.
And the valuation structure, the $1 to $1.40, is that driven mainly between on the mix of sort of work? So if you have a little bit more advisory work, which is a little bit less reliant upon the daily grind, is that drive a bit better sort of performance, or is it just profitability?
Look, I think if you asked 5 valuers in the room, you'd probably get 5 different answers. From my point of view, some people look at the advisory side as a negative because it's you can't guarantee it's recurring. So I suppose it also
a very conservative viewpoint.
Exactly. So sometimes the grind, so to speak, is potentially what people are paying for.
So like a real estate agent, they pay for the rental book and then everything over the top is just cream.
Yeah, that's a great example. Yeah, I mean, I'm valuing a rent roll and sales agency in Western Sydney at the moment, and some of the rent roll is really easy to value. You know, there's great data. They're marketing in themselves. But
subject
the
to
sales
default
agents,
going through, if there's a default trend going forward, though.
Oh yeah, absolutely. That would obviously, you'd have to factor that in. But in terms of the sales agency, that's really hard to value. I mean, I've got a publication from Macquarie Bank saying now, you know, people are paying equivalent of a cents in the dollar for sales agencies, and I'm seeing other evidence that people don't want to pay for a sales agency. So it's a tough one. It's difficult.
I'll just make a comment, I think, on some of the differing values on the annuity stream revenues. The businesses and practices that have very efficient processes and I guess high quality maintenance of records and well-documented systems and processes, in my view, would likely attract a higher multiple on the valuation, it may be indicative that they are able to turn that revenue into or achieve a higher
Profitability.
margin.
Yeah.
Higher margin on the delivery. And also from a transactional perspective, it may indicate that it's going to be easier for an acquirer of that practice to transition that book of fees and revenue into another practice if that's what they'd like to do, or at least for an incoming practitioner to again just allow for a more efficient transition of that business and a greater likelihood of a continuation of that business. It's obviously more challenging to extract a future owner to extract value when there may be a lot of undocumented knowledge or systems and processes.
And we see that similarly in dealing with a few of our retail clients. The feedback is that the market transactions going on, and this will obviously be an area where there will be a lot of transactions, I think, over the next 6 months as a few of them fall over, is that if your bricks and mortar sort of business, that's a one model, and your online business, if you have a strong online business, that can be 3s to 8s. So having a retail business, because you can bring it through at a much more cost-effective basis online. And Paul's written a question around a website. I think that's the same thing with retail. If you have a very good website, you have a very good database, that adds significant value now, because you can actually then monetize that and utilize that, compared to having to drag people out of their house to go to your store to buy something that they might be able to buy online and is cheaper and better for you, and you take more of the margin rather than paying somebody else. So that's going to be the new world. And I think you're right, Paul, having a good website is going to drive a lot of that, and being able for people to understand what they're going to get and how they get it. Have you seen that as well, Firthy?
Yeah, absolutely. Yeah, I agree with all those comments. I mean, the fact that some accountants don't have a website and are sort of proud of it, I just think is crazy, because it's such a good channel. I mean, I think a lot of accountants are actually really poor at marketing businesses. They're accountants. They're good at advice, but not necessarily marketing in many cases. So, but it's such a brilliant channel that works for you 24 hours a day. I mean, it's driven my business. A huge part of my business is web. So I've firsthand seen the value of a good website, and just people being able to read the information while, the middle of the night in some cases.
Yep. And a lot of, I suppose, your clients are probably working on their transactions and their valuations when they get a chance, which is probably late at night, when they've come home and dealt with their business during the day, dealt with their family issues, and then have a time at that time, right? So you might not be available at 11:30, but your website is.
Yeah, exactly. And they'll often quote that they've read every article on your site, and why haven't you updated some of the old multiples?
And more generally, Nick, what are you seeing in the market around people buying things and selling things? I mean, we've had contact from private equity this week about saying that they're open for doing deals and looking. And you've got a few engagements over the last 3 weeks to go and try and transact.
Yeah, Todd, I think as a general statement, in the closeout of December 2019, there was a lot of publications and data out globally around the quantity of cash sitting and waiting to be deployed in private capital. And that's, across a range of assets, everything from, venture stage businesses through to the large buyout funds, alternative lending, etc. That cash, to a large extent, is still there. Obviously, some holders of the cash are needing to redeploy that and rebalance portfolios and prop up some assets, but it remains. It was a low growth and a low return in the equities markets for an extended period of time. So this cash does need to be deployed. Outside of those, pure capital and cash holders, we've been talking to a number of private businesses who are their core business. Yes, it's taken a hit into some extent, but they are able to see a pathway forward, and they think that their own business model are okay. They're looking to continue with their longer term strategies, and some of those may be to pursue acquisitions, and for some of those sitting offshore, Australia is not badly priced at the moment with the Australian dollar where it's sitting. And so they'll continue to look forward. One of the challenges, as sort of Andrew mentioned, is when it comes to valuation, there's the sort of usual multiples and the like that may have been applied may not be immediately relevant now. A huge amount of uncertainty around whether it will be sort of a quicker recovery to a new normal, and multiples would return, and likewise taking a view on cash flows. There's a lot of uncertainty, and I think with that uncertainty, generally there is opportunities, and there are parties out there who see those opportunities for divergence in views, and whether it may not be the acquisition of a purely distressed businesses, but they can see the opportunities where they can acquire at what may look to be decent multiples, decent valuations. Because on the other side, we've had a number of conversations with business owners, and for some of them who have been contemplating succession style issues and thinking about a horizon to exit their business, some of them have been, that I've talked to, again, that their business has been traveling okay, but I guess the added pressures and the added stress of responding to the current climate has brought forward their decisions to exit their business, and i.e. they don't want to, it's crystallized their view that they don't want to be sitting in these businesses longer term, that they want to look to pursue an exit. Now,
so Nick, has that narrowed that gap that was sort of there between expectation of where pricing may have been? So that's meant that some of those businesses that have been rolling along okay, but not really maturing or making the change that's needed to go to the next level, their owners are now in a stage where they go, you know what, let's reassess and take what we can get and move on. Yeah. Compared to where they were previously, where it was, well, you need to pay me absolute top dollar, otherwise I'm going to stay.
Yeah, and Todd, it is because for everybody, most business owners always would like to achieve the highest value possible for their business, and that's absolutely understandable. I think what the current situation has allowed is for some people to sort of step back and actually look at what are some of the priorities in their life, and that if the actual impact of continuing to own a business and some of the stress and potential capital that's needed to be redeployed into these businesses to continue for them to trade, they look at it and go, well, is it worth bringing forward our exit timeframes, and as you indicated, revisit valuations. And yes, we still want to get a good value for our business, but we would potentially be comfortable to compromise on not achieving our previous top dollar, but land on something which is fair. So it's not no guarantee that it will see a transaction transpire in the short term, but I think it's bringing more parties to the table willing to contemplate transactions.
Can I throw a question or a comment in to the panelists? What I've seen in the last month and a half, and reading the papers as well, the press, is businesses being forced to reshape to meet the new environment. And you've seen that with retail. They've gone from having no store front, if you like, no bricks and mortar, to having to go online. And for many of them, that's been successful. So it will be interesting to see how their businesses reshape as we unwind COVID-19. They've been forced to go online, and they have been reluctant previously. And then I think, and some of the big retailers, you've seen that with Myers. But then, Andrew, I guess you do a lot of valuations for the really small businesses, the cafes and whatnot, and maybe some tourist-related businesses. I mean, they've gone from being able to sit people down in their restaurants to having to deliver takeaway. So again, they've been forced to reshape their businesses. They won't look the same over the next 12 months, because even if we relax, COVID-19 restrictions, which we're likely to do, the simple separation of people, the distancing required, means that they won't have the same amount of sit-down business, and they'll have to continue, to do the pick up and takeaway stuff. So it's going to be very, very interesting. Will that make them more profitable? I don't know, but it'll be very interesting. And what I'm saying too is it means we just won't see as many people once JobKeeper's unwound. We won't see everybody retained. I don't think that's going to happen because I think these businesses will fundamentally change.
No, I agree with that. I was speaking with a director of an event business yesterday, and his whole business has disappeared, and he's now scrambling to go online. But I'm sure every other event business is also doing the same. So, it's still pretty tough.
Yeah, and Tony, I think the sustainability of some of these business models, I think the entrepreneurialism and the ability for these businesses to pivot and continue to have some cash flow is quite impressive. It's going to be a little while before we see how sustainable those business models are, whether that be purely online plays or responding to greater takeout and the like for some retail businesses. I think they're going to be part of the mix, but whether they'll be sufficient for some businesses to purely rely on those methods for the longer term, it's hard to say. I think it's definitely a positive in the short term, the longer term, and as you said, once some of the government subsidies start to unwind in the later part of this calendar year, how are these businesses going to be sitting? One area that we are particularly sort of attuned to at the moment, and if anyone has any clients who are subject to reporting requirements, financial reporting and the like, will be the impact of some of the business valuations and protection, and also property valuations, particularly those that are subject to retail tenants and the like, and what impact, again, the uncertainty around continuation of and the assumptions that will go into passing rents and relative discount rates that apply to those assets is going to be some really challenging and just greater uncertainty as to how that those values will stack up when you're thinking to the longer term.
Nick, from talking to our sort of contacts in the property council and things like that, there are people doing monthly valuations on commercial buildings and on retail sites because they need to do that to be able to understand how it works. And there will be a material adjustment, I think, to that market and the REITs as rents change. Retailers have been whinging since the sky was blue that rents are too high. Now I think landlords are probably going to have to come to meet the market a little bit more, unless you're in a premium site. That could change that market, and then the return that sits for the owner, and then the debt holder that sits above the owner of the property, and that will be a restructure that will go through the economy. So that's part of one of the long and winding road issues we see that's going to create. It's going to be a new structure. Nobody can really predict how it's going to be, but everybody can see there's going to be massive structural change, and that generally takes a couple of years to wash through. And we see that there will be an initial change now as everybody gets back to some operations while social distancing is on, and then there'll be another change probably once there is a vaccine, hopefully, and then things return to a little bit more openness as well. Beyond that, that will be openness, but it will be different openness, and how people adapt to that will probably determine how they can go forward into the mid-2020s. So, but there's great opportunity, I think, for people to actually be able to do things and buy things and combine things and look at things differently and change cost structures now. And that's where I think people need to be thinking about.
Yeah, look, absolutely. And I think the core for any of those decision making, whether it be valuation or business models internally, or looking to other assets, are the quality of the cash flows and the ability of the operators of these businesses to have to forecast both their shorter term cash flows and then looking to their assumptions around those longer term cash flows and running the scenarios on those, because as Andrew pointed out, from a valuation consideration, that's the premise for the majority of valuations, whether it be converted into an earnings and a maintainable earnings number, or those raw cash flows. And I think some of the historic assumptions may no longer be appropriate, and whether that is short term, and this is sort of a 6-month blip for some businesses, to whether it be completely structural and totally alter the business models for some sectors of the economy.
So Andrew and Nick, if any of our people online, if they have clients who are now looking at selling and are trying to assess where their value sits, but as part of that process, what are the things that they need to be doing? Are they the same things they did previously, or is it new things that they need to be looking at and trying to understand to be able to maximize their value and make sure that they can attract as many people as possible as potential purchasers?
That's a good question. Nick, do you want to go first, or you want me to have
Yeah,
a crack?
I'll chuck in some thoughts. And look, I think often the valuation of a business and prospective sellers and buyers of businesses quite quickly jump to the financial and the pure historic financial metrics of some of these businesses. I'm a big believer that you can also look at what are the drivers for those earnings and financials, and a lot of that comes down to the actual strategy and the business model that's in place. Often if there's people involved, and documenting those systems and processes. So I would focus at the moment on the quality of where you sit in your market, the quality of your internal systems, processes, and people, and obviously, in part of that is the quality of your business plan and your ability to respond to situations such as the current interruption. So focus on those items. The short-term earnings, they're going to be a blip, and obviously if we're working on a sell side, we'll be doing a lot to communicate and explain why we think our business is going to rebound and it's going to be in a stronger position in 6 to 12 months.
Yep. And the only other thing I'd add is, I was talking to a business owner recently, and he was saying he had a part of his business that it was just always there. It was always making 20 grand a month. Whatever happened, it was just 20 grand a month, no matter how much effort he'd put into it or not. And then post COVID-19, he's saying, look, that business is now, we really look to that business now as a really attractive part of the business, whereas before it was just a bit of a side thought. So it's interesting. Maybe parts of businesses their attractiveness to a buyer are changing as it responds and is resilient to this type of impact.
Yeah.
Online sort of businesses obviously are more attractive, and we feel as though there might be a bit more restructuring to try and extract those bits of the business out of the structure and leave behind the bits that don't work or aren't as attractive.
Yeah, exactly.
All righty. Well, look, I think maybe we'll call it an end to today's discussion. It's been great. Thank you so much, panelists. Andrew, for joining us. It's been thank you for your time. I think the HLB community members who attended today will have got some great value out of that discussion. And Peter, thank you also for your update on JobKeeper. I guess it still evolves, and the date of 31 May is still a couple of weeks away. So there's still things to talk about on that front. And today the National Cabinet will give us an idea of how far they're willing to go. I'm pretty sure it's going to be baby steps, but nonetheless, it'll be interesting to see what they do today on the back of the evidence that's coming out on the number of infections, and which has been reducing right across the board, which is great news. All right, well, look, thank you so much, everybody, for attending today. Those that turned up, there's a polling question there to answer for those that still remain, and we'll see you all in a couple of weeks' time. So thank you for joining us.